Hello, this is Justin Paolini here from Building a Trader. Welcome to our 7th episode of Tales from the Trenches. Today we're going to talk about liquidity pools and how to fade stop losses. But before we get there, let me just go through the risk warning. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify profits as well as losses. You can lose more than your initial deposit. So before trading, please carefully consider the risks and the inherent costs and seek independent advice as required. Please contact us to discuss any questions or concerns you may have because we are here to help. Now, with that said and done, let's talk a little bit about institutional behavior, order flow, and stop levels. One thing I have to say as a premise is that a lot of this work on order flow in the retail space was done by a fellow called Damon Goldsmith. I worked for him at his previous business, orderflowtrading.com, for a number of years. And he wrote a book called Order Flow Trading for Fun and Profit, as well as a lengthy Forex Factory thread that might still be there if you go and look for it. But basically, a lot of the work that I will be showing you today stems from his initial work and things I learned working with him. But I have also verified his conclusions with some industry professionals that I know, just to make sure that things were not just a blind invention, but they actually had substance to them, and they do. So, with that said, liquidity. Liquidity is important because institutional traders need liquidity to deploy the huge trade sizes that they trade in the markets. Um, they need a pool of buyers that they can sell into, or they need a pool of sellers that they can buy into. Because without liquidity, these big orders will suffer slippage, and the cost of the trade might make the trade actually inefficient. Okay, and that's why there are execution algos nowadays that attempt to deploy a trade idea in an efficient way by sensing where there's liquidity. But also, our colleague Kane Eccles told us that there are predatory practices at the high frequency level that can sense large orders and front run them. So liquidity is definitely worth paying for. Liquidity is essential for large traders, and um, if we want to get into the institutional trader mindset, it is useful for us to also identify where these liquidity pools are so that perhaps we can trade alongside the big guys and not be stopped out and suffer uh, negative trading conditions just because we don't understand this dynamic. So liquidity can be found or can be created by a pool of stop loss orders. Okay, stop entries and stop losses provide liquidity because they're orders that are waiting to be fired off, but they're different than limit orders. Limit orders consume liquidity because they're then transformed into the opposite market order. For example, if I am buying into a dip with a limit order, okay, that limit order, being a buy limit, will not allow the market, will not execute if the market is trading below it. It will only trade at that price or better. So it's not as versatile as a stop loss order. A stop loss order is an at best get me out of the market or get me in the market at whatever price. Once that price level is triggered. So the stop orders actually offer liquidity to people that are taking the opposite side of the market. So from the perspective of institutional, a pool of buy stops, and this could be long breakout orders above a range, or stop losses from people that are short, they represent liquidity that can be used to short the market. Instead, sell stops, so short breakout orders or stop losses from long positions, they represent liquidity to buy the market. So a chart is worth 1,000 words. Where can we find buy stops and sell stops? Well, it's really, really easy. You just put yourself in the mental condition of a trader who has sold the market, and you think, well, where would he have his stop? And usually you'll pick the right place, because technical analysis is best used as a risk management tool. So we're always taught to keep our stops away from current price, outside of boundaries, outside of the daily range, etc. So we usually all put our stops in the same places. And the only thing is that previous stops can come under pressure, and if traders are not good at managing their positions, which usually they aren't, then there will be stop losses accumulating above or below typical swing points. So anybody who's who shorted cable down here probably has their stop losses way above here, right? There's going to be some stop losses above here as well, but this is the stronger level. So what happens when the market goes back up there? Anybody who is looking to short cable will be looking for the fake out. So for price to materially go above these highs, okay, because we're not looking at a pip perfect dynamic. You need price to actually materially break above, and then you can have a few different variations on the theme. This with a long wick and the rejection, with a very neutral close, this is showing tremendous rejection. Other candle formations could be, like this one here, the typical rails, bullish bar, bearish bar that eats up the bullish body. You could have a different kind of price action with a divergence in momentum. There are different ways that you can spot this this dynamic, but the key thing is that there is actually reversal action playing out. There is bearish action playing out, and you can see it on different time frames, but it's playing out after price negotiates the stops. So it's not staying up there and just consolidating. It's actually like forming a V-shaped reversal of some sort. Same thing down here, right? Stop losses are below these lows, and they get triggered. And there are stops. There's a stop cascade actually as price comes back down here, because you have higher lows, and all the stops that are below here and here get triggered on the way down, right? And so this just adds to the liquidity that buyers have if they want to push price back up. And that's the conditional. We always need to verify that there is bullish behavior going on before we step into the market. Okay, same thing up here. This was a key swing high. Stop losses were triggered, and you get the immediate bearish action. The subsequent hour after price broke. And now we have a couple of levels that are still waiting to be triggered as I'm doing up this video. So we have Friday's low. There are definitely stops below there, and there's Friday high, and then last week's high, which are two also visible sell stop pools. So let me encourage you to take this concept and see whether it can be useful for your own trading. How do we do this? Open up your Forex tester. If you don't have it, go into the link below the video and go get yourself a Forex tester with a discounted price. Then, identify a trending market based on the structure outlined in my free course. If you don't have the free course, you didn't see previous videos, go to the link below the video and go get yourself the free course. Identify sell stop levels in an uptrend or buy stop levels in a downtrend. Okay, identify them on the hourly, on the 4-hour primarily, if you're using the structure I outlined, and then wait for price to trigger the stops, and then wait for bullish behavior to ensue if you're buying, or bearish behavior if you're selling. And then show me your results. How did you do? Is this a useful concept? Is it helping you? Right? Is your simulation proving successful? Because if it is, you have a trading system that has just been built for you using this one market dynamic that will never go away. It's a market dynamic that will exist forever. It always has, always will. So that's a trading system already made for you. Now let me give you some additional information. Don't get carried away, and just start using any swing high or low or any spike. Okay, always be selective. Use daily 4-hour and 1-hour levels only. Don't get carried away on anything below the 1-hour chart, because we need enough liquidity to actually generate the stop hunt. If the levels are too small in nature, they probably don't have enough orders aggregating, accumulating around them. Prefer self-evident swing highs or lows that stick out like a sore thumb on the chart, right? It's also better if these swings coincide with previous day or week highs or lows. Play the metagame. Ask yourself, where would recent longs have their stops? Where would recent shorts have their stops? Because we're all creatures of habit. We probably would do the same thing. And prefer material stop hunting. Okay, so wait for the market to actually push beyond more than a couple of pips. Okay, let's not be pip perfect with this. And this should help you identify the better levels to use. How to spot a quality reversal. Tall wicks, slowing momentum, so the market breaks through and then it really slows down. Immediate reversal action, so like we saw before, bearish followed by bullish action or vice versa. A failure to close above or below the level on a higher time frame. Okay, or there could be also some divergence in momentum. That's also a big help. One thing I'd like you to remember that from my own experience, the hourly levels usually remain valid for the next day. 4-hour levels remain valid for the next week, and daily levels remain valid for the next month. Okay, so why is this? Because momentum and drivers tend to shift. Okay, and the stop losses can then become an accelerator. Instead of big players using the stop loss pools to fade the market in line with the previous trend, they could then just play through the stop loss levels, okay, and that would be an accelerator for whatever new move is developing. Okay, so that's just so basically this means that the levels you identify today on the hourly chart are valid for tomorrow, if they're not triggered today. The levels that you identify on the 4-hour chart are valid for this week or next week, but no longer than that, because usually things change. And I don't want you using this to fight a market that is starting to shift its dynamics. Here are some recent examples on dollar CAD. This is the 4-hour chart. Okay, so you can see evident swing high, with a lot of bearish action there. And what does the market do? It gets all the way back up there. Notice that your momentum in oscillators, whether you're using a stochastic, an RSI, MACD, rate of change, a CCI, any of them, they all do more or less the same job. They will usually be at their extremes when price is negotiating these levels, right? So it's a decent confluence if you want to use this. So market gets up there, materially spikes above the level, comes immediately back down, and that's encouraging action. And then the downtrend ensues; it just continues. The market also created a new swing level from which there was a decent decline, and you can see as the market comes back up, gets above the level, and then it reverses and it goes back down. Here it created another spike high, and this was triggered just last week. Not a material break in this case, but it had some of the other ingredients, and this of course is an art, it's not a science. So once again, another decent trade location, and the market pushed down. It wasn't able to break through the lows yet, so I'm a bit cautious on dollar CAD this week, but still decent place. You know exactly where you're going to where you're going to look for your trade. You know exactly what you're looking for, where you're looking for it, and that's as good as it gets. If we go onto the hourly chart, let me show you how the hourly chart is a bit more complex. Okay, so the key thing to remember on the hourly chart is that you need to take into consideration momentum and the previous day's action, because why do these levels, why does this level hold, and why does it hold again, and then this level really doesn't do much for the market, this level doesn't do much, okay, because the day-to-day, you got to be quicker on a day-to-day basis. This day closed in a negative fashion. So obviously, players will still be looking to short the market the next day. This closed, in a slightly negative fashion. It was more of a neutral day, but still intraday momentum is still to the downside, right? There isn't any visible bullish action going on. So when the market trades back up there, even though it's Asia, so poor time of day, the market still sells off. However, intraday the market recovers, and this V-shaped reversal doesn't really inspire shorts, from the stop loss level. Okay, and this would have been either a scratch trade if you took it, or you could have just selected to avoid it altogether. Same thing down here. Here we have a bearish day, but here, this day here that provided the spike high was actually again a V-shaped reversal. So it's a lower probability to be shorting this spike. Okay, it's much better to short the spikes or the swing levels in line with bearish behavior, and not when you have a strong shift in momentum leading up to that level intraday. So a bit more, there's a little bit more selectivity that has to be done using the smaller or the shorter term spikes. And the same thing, I guess you could say, for the 4 hour, just the 4 hours. In this case, we're coming from bearish weeks, right? We have a nice bearish week, so shorts are still the way to go. We had a bearish, fairly bearish end of the week, bearish action here, so shorts are still the way to go. And then bearish action that ensued from here, so again, shorts are the way to go. That's why trading this in line with the trend is perhaps easier. It allows you to select the levels properly, and it keeps you in line with momentum, which is always a good thing. Just a final reminder, whether this works for you or it doesn't work for you, it doesn't matter. Whatever you do, keep it simple and remain consistent. Final thing, I want you to remember that there are always opportunities awaiting once you are consistent. We have funding available at my partners at FCI Markets. So once you're consistent, once you have a track record, come on over and see if you can get funded via FCI Markets. I would love to work with you. And if you do need any coaching, then just come on over to Building a Trader, because that's what I'm here for. I'm here to help you become consistent so that you can take your trading to a new level. This is Justin Paolini for Building a Trader. Over and out.